Hello YouTube! Today we're going to be talking about how we have the potential for a new bull market to be birthed. I'm talking about how we stopped going down or how we broke this downtrend, and there is massive potential for us to go up. So stay tuned, and this weekend we're going to walk you through exactly how to get prepared because this is a jam-packed week full of data from the Fed, from earnings, and from everything else. So let's have a look at our pattern, which we've been using as our North Star for the last couple of months here. So we note that we have our falling wedge, we have a breakout, we have a back test, and then we can move higher. So I'm saying that there is potential for us to go higher. Keyword being potential. So I note here that we have our falling wedge and we've stopped going down. Now I'm going to explain the reasons why this could, keyword being could, be the birth of a new bull market. And if you're enjoying this weekend's video, I would really appreciate if you could smash a thumbs up and drop me a comment and let me know what you think. Are you bullish or bearish? And what do you think is important for us to look at this week? I think we've got a great show for you. Stay tuned and we're going to jump straight in here. So we talked about this before, and we've talked about the specific pattern that I was looking for us to actually confirm a breakout. So we got these red lines here, which signify that we have a falling wedge, which is the pattern we're looking at. And then we note that we stop going down by breaking out. And then we potentially backtest, and then we can move higher. So the first thing I just want to look at here is, again, this area here. The breakout gets confirmed on a close above resistance. What did we do this week? We closed above resistance. Why? Well, we closed over the downtrend. The downtrend is found at roughly 390. So the fact that we closed at 395 means that we have roughly a 1% cushion on a bullish breakout. All right, cool. So this is actually the start of a bull market if it can continue from here. And we have a very clear area or a pivot we have to watch for now. So if now we bring this back into here and we remove some of these lines, again, let's just delete all this. All right, now let's get rid of it. Second thing which is really important for me is just the low we would potentially be backtesting to. Again, buy or retest. So that is the actionable trading plan for this week. If we go up or down, I'll be watching closely. If we have a down week, I'm not saying that a backtest is bullish. The backtest is bullish if it can hold. If it can hold what? The relative low. So we're looking at the relative low here going to, again, the part of the falling wedge. So now I'm going to draw a pattern, which I've done before, and make sure it's clear here for people to see. Again, what is this? Well, it's an inverse head and shoulders. So again, let me try to draw it a little bit better. There we go. So what it means is that the low that we established on this last leg down before we set our low cannot break. So now let's go back to our pattern and let's look and see if it held. It's that 380.54 Justin just keeps talking about. Yep. So if we backtest here and we hit that white line or the pivot and we don't lose it, what is that? That's a bullish backtest of the breakout and a pass. So we're backtesting the blue line and we're going to pass. What is this week's low? It's 380.66. So you can note that number up here at the top of the screen. You can also note that the low I'm looking at is 380.54. What is that? That's a save. It passed. It went higher. It broke out. Cool. All right. So now we got the second piece of evidence for the bulls. Now let's look at the last piece of evidence. I'm looking at the last part here, which is roughly where we actually hit this high. So I want to know, did we make enough progress to the upside to say that we broke out with conviction? This was not just again, like a dead cat bounce or a bear market bounce or whatever you want to call it. So what I'm looking at here is we have 1, 2, 3, 4 lows. The last low being the low of the year. And this one here is going to be our IHS. But before that, we have 2 more lows we want to look at here. We almost make it to the first low, but it's roughly in between the first and second low. Now let's go back to our pattern here and see where we actually made it to. So again, this is art, it's not science, so bear with me here. So here's our last low, here's our second low, here's our third low, and here is our first low. Now let's look and see roughly where this 400 test lands. Oh my goodness, it's pretty close to that first low here, and it's in between the first and second one. All right, let's go back to our pattern. Oh God, right? That's roughly where we make it to here, again, on the classical textbook definition of a falling wedge breakout. So is there enough evidence for us to say that there is a case for the bull market to begin, that it's here, and that it could be real? I think yes. So stay tuned, and through the video, I'm going to explain how we can make sure we are prepared for this move and the evidence we have to pay attention to this week. So there we go. In about 5 minutes, that is the simplest way for me to explain where we are. I would also note that I've been on holidays for roughly the last 3 sessions, which means that I'm coming back and I haven't been really watching the market for the last 3 days. I haven't been trading. I bought stocks before I left though, and I had conviction to do it. So my point here is that after I'm coming back from holidays, I am trying to understand what the market did. I'm not trying to tell it what it's doing. I'm trying to understand. Can I watch the movie and can I understand what it's telling me? And as of right now, the answer is a resounding yes. I'm now going to show you the note that I actually left for our team before I left. If you want to know more about that, click on the link in the description. You can see what I'm talking about. So, going back to here. So here we can note that on July 20th, I said that R2 claimed, I would like to see R3 claim by Friday to confirm the momentum to the upside. R3 for me was 396, which is the beginning of the daily gap that we see on SPY. We'll look at that in a moment. What I want to look at next here is just that on Wednesday, I just wanted us to see us penetrate it, not hold it. Where did we close? 395. Perfectly. Why? Options, of course. But second thing here is just that all that I wanted to see on Wednesday in pre-market or when the market opened by Friday, which was yesterday, was a weekly close over 390 to what? Stop going down for a bullish break of the downtrend. That's it. What did we get? Oh my goodness, we got it. So there you go. There's a special note here only for members. Encourage you to look at the channel if you want to see what that is. All right, so moving forward, did we close over 390? Yes. So now I want to look at that 396 area and the reason why it was so important. Let's now look at our daily chart here. Let's pull it up. And we're going to look and see that, oh, it's actually continuing the bull momentum here. So let's have a look here, 396, which is our yellow box here. So I'm just going to zoom in a little bit so it's a little bit easier to see. All right, so our yellow box, the gap, which I'm looking at right here between 401 and 396, we have a high of 395.78. I'm calling it 396. And then here we have 401.44. So what did we do? Well, we poked inside it once, we busted over it, and then we back tested, but roughly closed within it. We almost closed the gap. It's almost filled. We had a high of 400.18. which means we're roughly within $1 of filling the upper gap here. It's still there, just like we have a small gap left on the downside, but we made substantial progress. The bulls were not able to hold us down. And the next thing, which is really bullish for me here on the daily chart, is just that, look, we stopped going down. We connect the highs, and what did we do? Well, we broke it, and we back tested it. Cool. We're also above the 50 DMA, which gives us what? An uptrend, which means we're actually trending up on a daily time frame. Cool. Next thing to look at here is a 3 white soldier pattern. So a 3 white soldier pattern, again, it's not actually off the low, but what I'm counting here is the fact that we had the hard reject on a gap up, we flushed all the way down to strong support, and then we have what? We have this bullish pattern right inside of here. This right here is called 3 white soldiers. It's called 3 white soldiers because each day opens within the range of the previous day, but closes at or near the high of the day. So what do we have here as we're building up momentum from Tuesday, Wednesday, Thursday? Oh man, right? Open within the previous range, near the high of the day. Open in the previous range, bounce off the 50 DMA, close near the high of the day. And what about Thursday? Same thing, gap within the range of the previous day, stage yet another higher low, close near the high of the day, and then we get the reversal. And from last weekend, the video we left you with was a bear trap. So did we set another trap again? I don't know. But on Monday, those bears believed it, right? They piled in, they're like, oh yeah, this is it. We only made it to 389. Gaps are left on the upside. It's time to short this thing to 0. They got trapped, right? Obviously. And what's really interesting is that when we look at the low that we staged on Friday, it's 39275. What is the high from our first pump day or the first day that the bears were told you're wrong? It's 39287. So what does that mean? We actually staged a higher low over the 50, and we also backtested the high of the day where the bears got trapped yet again. So what does that mean? These bears continue to suck, and they can't even print it. They can't even print it like 20 cents below the first day from the 3 white soldiers. So I think that with this close on Friday, the bears are like, oh, that's a hard stomp off 400. Time to short it down to 0 again. I think that's a little bit ill-advised because I think you're a little bit late to the party if you are shorting fresh right here. If you have proper risk control parameters, no problem. Take the shot. Go short. Just remember that this has been the worst sell-off in more than 50 years. So you think it's going to turn into the worst 100 years, worst 500 years? Like, come on, how much worse is it really going to get? So there we go. Also important to note that the P&L or profit and loss for those big short positions is starting to get eroded, which means that they're going to fight it, but at a certain point, they're going to have to unwind those positions to ultimately not lose money. That is our goal in the market, is to not lose. All right, so one more piece of evidence. Here's another piece of evidence. So now we understand what we need to do. And here I'm noting that we are still in a bear market, which is the current status, but the bull reversal is underway. It is not yet confirmed. I've shown you the evidence so far. So now what we need to see is, what do we need to know to actually break bullish, and what do we need to see to break bearish? For me, a bearish break would be a close below 380. Because again, one more time, that'll be us losing that 380.54 low, which is going to be from the weekly, but also we're going to be confirming that we're not going up. We're going to be falling back below our downtrend, back below 380, and we're probably going to go down to a lower bear market target of the year. Going back to our weekly chart to try to explain, to make sure everyone is clear, we go back to here. It means that if we also fall below 380.54, we're doing more than a back test of the falling wedge. We're going to fall back inside the blue line, and we are going to resume our downtrend, probably hit that 200 weekly moving average, or the black line at 352, which will curl over. And then we have a big decision here at the end of our apex, at the end of August. So again, there is a clear line in the sand for me to say that we are breaking back to bearish, and this was a trap for the bulls. On the flip side, if we can close, if we can get above 401.44, we close the daily gap. We also form another weekly higher high. And if we can get above 405, it means we're back above another psychological area. And the reason why this is so important is because last week we were looking at a 380 straddle that was getting put on with what? 25 points in premium, which means they get their money back at 405. That 405 number is going to be so important a little bit later in the show. And remember the straddle, okay? Just stay tuned. When we get to the option section, I will explain what's happening. Almost every major stock that reports this week, I'm talking the $1 trillion companies, they have straddles put on for the option plays going into earnings. That's a big deal. So a 405 is the break-even area for the S&P straddle. What it means is that the market makers who sold those options are now allowing them to go in the money, which means now they've got their money back and now they're actually making money. That's very important. Why? If they can't avoid payout, it means that the people who bought these things are in control and they want the bull or the call side to pay out. All right, so now that we know the levels, let's continue the story. Have we made enough progress into the bear market targets to say that if this bounce happens, that it's going to be real? Let's see here. Well, we hit the December low at 449. We went down 10% at 432. We filled the gap at 400, which was the gap that everyone was watching, myself included. Where did we reject? Roughly there. It was 400.67 to be precise. We went down 20% on SPY. We hit the 2020 high. We hit the 2021 low. And now we can see that our 200 weekly, our 50 monthly are starting to curl up to provide strong support at high 340s to low 350s. And then finally, our last bear market target is here at 339 and 336 to go down by 30%. And that would be my ultimate target for right now, if we have a shallow recession and things are not going to get a lot worse from here. So out of all the different areas, we got 1, 2, 3, 4, 5, 6, 7 total pockets where we're looking for support and bear market targets. We hit 5 out of 7. So 5 out of 7 is going to give us a number of roughly 70%. 80-20 rule tells me that, hey, we've gotten pretty close to most of the targets. It looks like we're forming a bullish pattern, which most people do not believe. And I think that if we get more continuation, I think that we're due for a big bounce. So last thing I'll point out here, just in terms of the technicals of where we are in the bull and bear market, a bull market is defined by 20% off the lows. So if we were to rally from here and we go up by 20%, where do we land? Oh man, we're back at 436. And again, what is that? That's the 50 weekly moving average here, or 435.38 as of right now. And as we've explained in previous videos, if we roughly test the 200 weekly moving average, and again, so test the 200, get back above the 50, what is that? That's a bull expansion. Roughly test the 200, actually going below, get back above the 50 weekly, there's your bull expansion. Let's go back in time even more. All right, 2011 or 2016, sorry, right? Almost test the 200 like we did here, back above the 50, bullish expansion. Cool. Let's go back in time even more. All right, 2011. Cool. So lose the 50, get roughly to the 200, back over the 50, big bullish expansion. Those were a lot of gains. Yes, sir. They were a lot of gains. The only times when we did not reclaim the 50 weekly is when we ultimately had a deep recession, or when we went down from peak to trough by 50%. And what was the again, what we were looking for confirmation here? Hit the 200 or lower, fail to reclaim the 50, which leads to what? The ultimate decline of 50%. What happens here in 2008? Hits the 200, kisses the 50, rejects. Cannot get back above, death cross confirmed, straight down. There's your negative 50. So now, technically speaking, we would birth a new bull market if we can get above 436, and that would be where? That would be above our 50 weekly moving average, where I believe we've gotten close enough to the 200 weekly that if we can go up by 20% from here or to roughly 436, that is a bull market. I would also note that the area here where we're going to be down by 10% is 432. So if we're going to be at 436, it means we are above 432, which means we are exiting correction territory or negative 10% off the highs, and we're birthing a new bull market. Is this going to be a healthy bull market? I don't know. We're trying to forecast the future. I only know what I see in front of me today, right now. But again, another piece of evidence that if this is the bottom and we see continuation, man, we could go like a lot higher. Absolutely. All right, now I'm going to jump forward to one more section because I want to show that this is the most significant jam-packed data week, let alone earnings, of the entire year. If you do not know this, hopefully you do now. Every single piece of data here has the potential to move the market, just like it did last week. We ultimately closed quite a bit higher. So what I'm looking at here is what happens by Friday. Again, there's red data this week too because we have the FOMC, we got GDP, we got CPI, we got jobless claims, we got durable goods, we got home sales, consumer confidence, two-year note auction, PCE, which is the Fed favorites gauge, consumer sentiment, and we got a whole bunch of earnings coming in, right? Meta, Shopify, Alphabet, Apple, Amazon, right? All the companies that really matter after last week. Okay, cool. So why does this matter? Now we're going to look at an hourly pattern, where here I'm looking at, again, the downtrend we've been looking at for quite some time, but now I have this new trend line drawn here, which is an uptrend. Why? Well, because we started going up. And what I'm looking at specifically is the area inside of here where if we continue to coil up, let me actually just get a little bit closer here to zoom in. All right, so if we're able to maintain this uptrend or not fall back below roughly 390, what that means is that we should be coiling up all the way up into here, and we're going to hit an apex or a decision point on the chart where we're going to decide if we're going up or down. When does this land? Roughly 1 o'clock on Friday. So if we're above 400 on Friday close, or we're below it, what does that tell you? It tells you we're either breaking bullish with continuation or the bears are retaking control. So by the time we get to this last data point on Friday, core PCE and consumer sentiment, if we're higher than 400, it doesn't really matter what people think. The reaction to the incoming data or the news is bullish, and we're continuing the bullish story of continuation and breakouts. These companies are going to tell us what's happening too. And last week, there was only one company that really disappointed. So we cannot ignore the fact that a sour reaction to a stock, which is not even all that terrible, to be honest, right? They missed EPS here by 26%, and they missed on revenue by 26%, or a 2% surprise. Sorry, the 26 million or 2% surprise. But it left a huge overhang on Google, on Meta, and the stock is down another 39%. This was the opposite of Netflix, where bad data was received as bad. So this wiped out, I believe, 81 billion out of the advertiser companies in technology. And we have to remember that if we hear negative stories from collectively Alphabet, Meta, Apple, and Amazon, that could be all it takes for us to lose that 380 area and to actually confirm we're back into the bear market base case, or what is most likely going to happen. All right, so we've gone through this one here and explained it. Let's close it out. We went through a couple more things. Now, another piece of evidence for the bulls. B of A survey shows full investor capitulation amid pessimism. Global growth optimism at all-time low. Fund manager survey. B of A inflation seen falling, but mood still stagflationary. Again, just ignore the stuff if you don't know what it means. So again, PJM's Greg Peters says we're looking at a prelude to a recession. Keep that in mind. In one moment, I'll show you the reason why it matters. Investors slashed their exposure to risk assets to a level not seen even during the global financial crisis in a sign of full capitulation amid a dire economic outlook, according to Bank of America Corp's monthly fund survey. So what does that mean? They have lower risk exposure even going back to 2008. Why? This has been a slow-moving recession where we've kind of talked ourselves into it, and everyone has had time to adapt, shift, modify their strategies. And when everyone sees this data, capitulation means that we are approaching a low. We are not at the low. And all this really depends on whether or not we're going to have a shallow or deep recession. And remember, we have GDP numbers coming out this week in America, but also for France, and for Germany. So going back to the survey, again, this tells us it is a prelude to a recession. It is not the recession coming on right now. All right, next piece of evidence. All right, here we're going to look at Bitcoin, and I believe we got the S&P too. So here we go. Bitcoin right here. I tweeted this out on July 16th, and I said that BTC could be heading to 25,000 if we can reclaim the 200 weekly moving average, then looking for relief that may turn into more. What do you see? I'm really interested on this part right here where it says capitulation, which is where I believe we were in the pattern when I took the screenshot. So we have a massive M here. There's a red arrow pointing to the relative low. Why? After capitulation, which is I'm getting 100% out of the market, I can't afford to lose more, we look for a dead cat bounce or a curl to hit the relative high here, or the capitulation low. What do we do? Let's have a look at Bitcoin. Oh my goodness. All right, so let's have a look here. Let's adjust the red line to the relative low here at about 25K. 25,338 to be precise. What's our high from this week? 24,287. 24,287. We're back below the 200 weekly, but we basically hit the area. So if this is capitulation for crypto, but also for the broader market, are we looking for more? Again, may turn into more. So we roughly hit 25K. I would say it's close enough. If we're going to get more continuation from here, that could be that we're seeing the riskiest asset, or Bitcoin, starting to go up. Noticing a very similar pattern here on ARK and also on IWM, or small cap Russell stocks. So we look here at ARK. This is also our psychology chart from before. And the area we are struggling with a lot is the same relative low that BTC is battling with. That's where the pink arrow points to. So we note that we stopped going down on ARK, but we're having a really hard time inside if you're actually claiming and closing above 46.2. But we finally did it by 5 cents. That is correct. We've closed above our relative low, and ARK has been a dumpster fire for quite some time. It's lower than it was in March or April of 2020. So for me, that means capitulation. It means we start to go sideways. So, okay, if the riskiest assets can now go sideways, what does that mean? It means sellers are exhausted. Why? They've capitulated. They're out. They got peak pessimism. They're not even in the market. They're more bearish today than they were in 2008. So cool, right? Another piece of evidence. Now let's look at the SP 500. So the SP 500, again, we have our bullish pattern right here. Our psychology chart right here. We note the pink line. We got our green support. And now let's look at S&P on its psychology chart to see if there is capitulation yet. Let's remove the VWAP. I forgot to do this ahead of time. I'm sorry. Here we go. All right, updated chart here. What do we have? Okay, so we've got it. We're still below the pink line. We almost kissed it. Right now, that's at roughly 405. Another reason why 405 is so important. But what I want to look at here is, again, we bounced off the low. We're now trying to go back up. And is there evidence? Yeah, well, we're back below the first low. Check. That's a 380.54. We have to get back above 405 for us to potentially shoot up to as high as 454. Why? That's what the pattern says. If we can get above the pink line and we start going back up, that is where we could max out. So the S&P is also showing that it's due for some relief. For the broader market to actually go down, I think we're going to need a deep recession. Right now, we are on track for a shallow recession, but we're likely not going to avoid the pain of tomorrow because we're not through the cycle yet. The cycle is underway for the S&P. So I think that when we look here, how long could this be? Well, it's a monthly pattern. So if we look roughly 12 candles out, because each candle is worth a month, right? We look at here, 12. Oh man, we're like all the way to the edge here. We're right about right here. So what that means is that we're going to be approaching the apex. Why does this matter? It matters because when we have an inverted yield curve, or the 2-year note goes above the 10-year note, that could be up to a year before we actually have the big recession everyone's looking at. And there's a key indicator I am looking at right here, which is screaming at me. I'm looking here at the US 2-year, 10-year. Again, we're looking at the comparison between the 2 and 10-year note. So what do we have here? We have an all-time high at 1.088. That's going back to 2000 in August. Our high right now is 1.083. We are very, very, very close to actually making a new all-time high, which means the yield curve is even more inverted than it was in 2008 already, higher than it was in 2018. It's going back to 2000 levels. This is the second all-time high that we formed now, right? The closest level to the all-time high that we've seen in quite some time. So this right here has to start coming back down, or this case right here does not get as strong. Other thing I would note is that the DXY, or the dollar, is actually coming back to, I need to go to a different chart here, sorry. I need to go back to this board here because that's where I have everything drawn. All right, DXY. Now we go back to DXY. It closed 1.6 cents below the key area we're looking at. Are we finally seeing peak dollar? Let's go back to, again, 1987. So we got 1987 here, 1989, sorry. I was about 1 year old when this happened. So again, I didn't trade through this, but I can go back in time and see if it's rhyming. So we got 106 point, the high right now, I know it's 106.56. So where do we close the weekly out? 106.54. What is that? It's below 106.5. That is after the ECB and the BOJ, which we talked about last week, raised interest rates in Europe for the first time by 50 basis points. So if now we're looking for the inversion on the 2-10 yields to start coming back down, we're looking for the dollar to potentially, keyword being potentially, start coming back down, what would that mean? It would mean relief. It would mean that we're looking to go back up higher. There we go. Another reason why this might be the bottom. Why? Well, look at fear, right? We started at, we started at like 6 back in May. We're here to 39. We need to go up by roughly another 11 points. Now we're inside a neutral, which gets us a lot closer to greed, which could what? Snap us higher. That's how we start getting fearful. They don't believe it, right? Fear-led rally, wall of worry, whatever you want to call it. Boom, get to the top here and greed starts kicking back in. That is the ultimate trap. So there you go. I'm not saying that we're going to be going to infinity and beyond. I'm saying that we're due for a bounce. Why? Technically, fundamentally, and economically, we're due. All right, so now with all that together, let's look at why we're bullish and why we're bearish. So peak inflation or peak hawkishness, which I've shown you the example of now. A shallow recession, which I think we're going to get. As of right now, the GDP now on the St. Louis Fed is projecting a contraction of 1.6% for Q2. We talked about this before. There is a bureau which certifies a recession. 2 GDP quarters of contraction is the classical definition. It is not the current one. So with a strong labor force, I think we're going to have a shallow recession or a growth recession, and we're not going to have a labor or job recession. And as of right now, we do not quite see the earnings recession, meaning companies are reporting earnings, actually saying that they're in trouble. So that might come later, Q3, Q4. But as of right now, we're noticing that yes, we're likely going to be getting another negative print on Thursday, which is going to show us that, yes, we've had 2 negative quarters of contraction, but is that technically a recession? I'm not the one who decides, so I don't know. There we go. So shallow recession looks like that's what's baked in right now. We're also back above the 50 DMA. What does that mean? We're above the short-term price on the daily chart. We're making progress. We're above the 200 weekly. We're above the 50 daily. What does that mean? It means we're trying to go back up. On the bear case, 454 becomes an unpenetrable fortress. And I talked about the reason why. It's a head and shoulders area. It's also where we could max out on our psychology chart here, 454. So if we can't get back above 454, even if we are above the 50 weekly moving average of roughly 435, this is just the bear market bounce before we go down by the negative 50. DXY and TNX breakouts. I just showed you that, yes, technically they are still breaking out. It might be a back test on DXY before we go to 120. Why? If we don't cool off here, we have a golden cross, we have a W, and we have 120 as our next target. That would add significant pressure to the S&P. All right, moving forward, deep recession risk. I think that's going to come into the later part of 2022 or into 2023. Tara, which is the opposite of Tina. There are reasonable alternatives. So Tara means that there are alternatives to the current things that people buy. You can buy Chinese bonds. You can buy bonds in Europe now. You can raise cash. There's reasonable alternatives. All right, key dates. So pause the slide. Every single one of these is important. I'm not going to beat the dead horse to explain the reasons why they're important. If they're bolded and underlined, you know that they're important. If they're red, they're extra important. On Monday, we have a 2-year note auction, which is going to kick it off, and that'll be really important to see whether or not the inversion is going to accelerate or it's going to stall out at 1088. I'm watching that really, really close. And then by Friday, I already told you that we need to be above 400 or roughly 1% higher on SPY to have all of this be interpreted or the reaction to the news being bullish. Now we want to look at earnings here. All right, so when's the big ones? Well, it's on Tuesday close, Wednesday close, but really on Thursday. Why the king or Apple is reporting, and then Amazon's also reporting. Meta already gave us a sour note for advertisers like Alphabet and Meta, so if they come in with a disappointment, I think it might have a negative reaction, but it'll be more muted because people have already had a chance to take the Snap earnings and apply that to Alphabet and to Meta. Now what I want to look at is going to be the earnings whisper numbers. So all I really want to look at here are going to be two numbers. I want to look at what the consensus is for earnings. For Apple, that's 113. The whisper number is 119. Again, these numbers are not always going to be correct either. They were expecting that Tesla was actually going to have a miss, and Tesla crushed it, right? I was surprised by Tesla. Apple expecting a beat. What I'm looking at next here is the options they're buying. On Tuesday, July 12th, there were notable options of, again, I'm going to skip the number of contracts, but the 145 calls and 145 put expiring on August 19th or the August monthly expiry. What are they doing? They're buying a straddle. They're buying the calls and the puts on the same strike, which means they think Apple is going to move massively. They just don't know which way. So 154 or 145 is the pivot, and they think we're either going to have a big move down or a big move up. What is that? That's them just not knowing, but wanting to be positioned for a large, oversized move after they already put those straddles on SPY at 380. Okay, cool. So Apple, right? Expecting a beat with a fat straddle. Now we look at Amazon. Amazon's EPS is estimated at 15. We're looking for a whisper number of 14, which means a miss by 1 cent. They're going to miss. Is that going to be enough to take it down? I don't know. Next thing to look at here is that they're buying the 120 call and the 120 put for August 19th. Another straddle. Cool. Looking at Google. Consensus is 128 EPS. Whisper number is 124. What is that? Another miss. Another miss here. So that's important because Alphabet might miss too. What we note here is that they're just buying naked calls. So they're buying 115 calls, and that was on Friday. Again, after Snap already took it down. So again, Alphabet's a little bit different here, but we've already had a chance to bake in the miss from Snap. Looking at Microsoft next. Microsoft, we're expecting 228 consensus. EPS from whisper number would be 237. What are we also looking at here? 270 calls, 270 puts. Another straddle. Interesting. Yes, very interesting. And then finally, if we look here at Meta. So Meta expecting 251 consensus, 253 whisper. Beat of 2 cents. Okay, so advertisers are mixed. Alphabet, Meta, mixed. Microsoft, Apple, beats. Amazon, slight miss. Mostly straddles though. Meta, on Tuesday, July 5th, they bought a whole bunch of 200 calls and again, naked call buying. They don't want to be protected to the downside. Meta's already all the way down. So between all those ones, it tells me that we're looking for an oversized move up or down. And because they're buying straddles, they do not have the conviction one way or the other to make a call. As I'm looking here too, I have a lot more data I want to go through, but the video is already 34 minutes. So I'm going to jump to my option section, and then I'm going to see if there's anything more relevant we want to do, look at a couple of charts, and then wrap it up, because I think I've done the best I can to explain what's important to me. I cannot tell you what's important to you, but I can tell you that I've been bearish since about November and December. And as of right now, I am seeing much more evidence that is bullish than that is bearish. It does not mean I'm right. It just means that the evidence, like a lawyer, is telling me that I need to be receptive or aware of the potential for a bull break. If we look to the chain for Monday, we note that we got 395, 390 put spread. That's the most notable thing to me. Want to see if it converts to open interest over here on the right-hand side. And then we got 400 as the fat daddy stack. And we got call starting at 395. So 395 would be max pain. Where did we close? 395.09. Ah, those pesky options. Yes, sir. 400 is the most important strike too. Why? There's open interest and there is the most volume. Looking at Wednesday, which is going to be right in the middle of the week. And this is going to be on the day we have the FOMC press conference, or when we confirm what Jerome is going to do. What do we got? 391, 390 put spread. Cool. 388s as well. On the call side, we got 400 and we got 395 again. 400 is the second most busy strike after 390. So this one's a little bit mixed. No clear picture. People don't generally position heavy onto Wednesday though, because Friday is just a little bit more expensive, but provides more time. So if we look to Friday, or after Jerome and after all the key data, including earnings and everything else, what do we have? Okay. We got 400 and we got 395. There's no real call buying below 395. For the puts, they start at 395, really 396, but they go down to 390. Also roughly equal for 390 puts for 400 calls. What does that mean? TBD. I don't know. 395 appears to be max pain again. So again, if we're going to be below 400 by Friday, as I showed on the hourly chart, it means that we're not going to be going up anymore. We're going to be stalling out. We could be at 400, could be at 390, could be right in the middle. I don't know. Finally, looking to the August monthly expiry, which is that same chain that most of these big tech earnings are positioned for. If we now look at the chain here, let's see if there's any continuation. All right, so we got 400, and this actually looks like a straddle to me. Why? Well, we got 30K on both sides for open interest. There's volume here again. They're buying 395, but it's not really huge. But then we got this 390 here as well. So this kind of looks like a call spread from 390 up to 400, but it could also just be a straddle. We're here with the 390 puts. Also noticing that we have 395 down to 390 as well. So what does this mean? Well, 395 is still max pain, is what it looks like. They're buying. They are buying more puts than calls. But is that a bear trap? I don't know. Is it the bears being correct? I also don't know. So the evidence on the options chain is mixed, but both sides appear to be positioning for what they believe is going to happen. All right, now let's go to my final board here and see if there's anything else that's relevant. So let's go back to here. I had a story I was going to tell with all these different news articles, but I'm just going to go through them really fast. So broken bulls, big breath, weighing a case for turn in stocks. Extreme low equity exposure points to urgency to chase rally. What could that be? A short squeeze. So you can read this whole article here, but I want to focus on a few things. The data in the bull camp are as follows. A third bid week in for small caps. Signs ETFs fund buying have become healthily demoralized, and measures of market breadth expanding in ways that we have not signaled further in the past. So if we look at the heat map, that's also going to show us here. So we understand all this stuff, right? Roughly as many features of the latest rally we present in those that fizzled early in the year, this is one that has outlasted all of them, even with Friday's hammering. What does that mean? It means that this recovery outlasted previous attempts and is accompanied by falling yields. What is this? This is the potential, keyword being potential. For what? For a reversal, a bull market birth. Now let's look at the heat map to see what it tells us. We look at the last 1 week or smooth the data out. It's pretty bright green to me. Yes, sir, pretty bright green. Let's zoom out to the last 1 month. Same themes, which means people have been accumulating not just for 1 week, but for the last 1 month. Cool, you do it, bulls. All right, last piece in here was also the small caps. So let's look at the Russell really fast. Here's the Russell. What did we do? We bounced off 2018 and 2020 highs. We closed over the 200 weekly. We hit the downtrend. Again, the downtrend's the blue lines. We hit the downtrend, and if we can just go sideways for next week, we're going to stop going down. Another piece of evidence for the bulls. All right, these bulls appear like they're ready. And then last one here. Bad news baked in. Stocks bounce back despite earnings downgrades. What does that mean? Stocks bottom on bad news. That's what happens. Stocks bottom on bad news. This is telling us the same thing. All right, Powell's key indicators shaping the Fed's rate path. Economists say CPI Michigan inflation survey are key data. So instead of reading the whole article here, I want to just show you that Powell's in favorite indicators. So what I'm going to be looking for is going to be the reaction to these data points that we're going to be getting later this week. Why? I want to see if the market is confirming whether or not Michigan survey and consumer price index are the second most important indicators. Why? We're getting some data this week. We got core PCE and consumer confidence coming out on Friday. All right. And then a few more things here just to try to fully tell the story. So we talked about, capitulation. We talked about that. We talked about the psychology chart for SPY. We talked about, earnings recession on deck. While so far, the earnings have been isolated to a couple companies that are bad, like Bank of America and like Snapchat. Otherwise, it's been healthy. There is breadth and there is depth, as we noted before. This is one where it might catch up to us next earnings season, where, again, we notice that corporate margins are really off consumer sentiment. So this usually will come back to find a middle ground. It doesn't have to be immediately, though. We talked about the Powell levels, and what's interesting too is that, again, the S&P is approaching a crucial 200-week moving average, or the Fed put, and we bounced. What does that tell you? Well, maybe that's the bottom. My note back in June 25th was, did we just get a Fed put or just another trap? I don't know yet, but the evidence is building up for the bull case. I cannot ignore it. All right, we also have the Goldman Sachs president, John Waldron, says the Fed is making the right moves to tackle inflation, after saying the central bank had lost its credibility at the start of the year. I actually forgot I want to show one more thing here. So if we go down to the bottom, split view on Powell. Most economists praise his citing of individual data points, though some say it's not coherent. So 40% say that there's not a coherent plan, or again, something that is clear. 60% say he's nimble and flexible. What does that mean? Well, if Goldman Sachs is warming up to him as of, July. What's the date on this actually? July 19th. They're warming up to Jerome, saying that, hey, he's actually doing his job. So is Larry Summers, people smarter than me. So, all right, recession is now consensus. So everyone's looking one way. And I don't know that everyone looking one way is going to do it because people have had all this time to prepare for the recession, not like previous times happened like that, right? We're in recession, boom, didn't have time to plan for it. We've already seen all the slowing hiring freeze, including Apple this week. We also note that core CPI is actually ticking down. Is it enough? We'll hear from Jerome on Wednesday. Watch what he says. The dot plot as well, revised down. That's the peak hawkishness. And peak inflation, potentially. Something else here too, going back to May 12th, was that I was talking about whether it's almost over. We were at 6, or extreme fear. No one wanted to hear a bullish narrative. If you look back at SPY here, going back to May. All right, May 16th, which is where we formed our 380.54 low. No one wanted to believe that could be the low. It's looking like that is now the key pivot, and we've notched from 6 all the way to 39. That is huge. We talked about the bear market targets, talked about earnings. So with all that, it's going to be really important where we shake out by Friday. Video's now almost 44 minutes. I'm going to go through a couple more charts really fast just because I want to set the tone, and I will circle back on these later in the week to explain more. So QQQ. Let's look at QQQ here. So again, what do we get? Well, we stopped going down. We have an uptrend. We're back above 300. We're out of the negative 30% territory, trying to reclaim a relative high, which goes back here to August 2020. And it's above it. Bullish potential. DXY, back below 106.5. We talked about it. VIX, still in the low 20s. It's below its 50 weekly moving average as well. Volatility is dropping off. We talked. I'm not going to look at individual yield curves like 2s and 10s. I'm just going to look at the inversion. It's accelerating. It's right near the high. Need to see that thing cool off. Look here to oil. Oil is also ticking down, right? Inverted hammer, down 3% on the week, resting on that 50 weekly after failing to hold a cup and handle pattern. Look at Bitcoin. Again, I'm watching that 22,700 area into Sunday night when it's going to close out its weekly chart. And I want to see if we can make progress up towards 25. Ethereum is going to be getting a upgrade from proof of work to proof of stake in the second week of September. It's also made it all the way up to roughly 1,700, which is its key relative low, already well above its 200 weekly. The trillion-dollar companies, which are going to report this week, again, looking for a straddle. Apple kissed its 50, backed off, but closed above its relative low. So Apple is above its relative low, but kissed and rejected off the 50 weekly, watching really close. Microsoft, if it can just go flat, it's going to stop going down. Getting above 270, or our relative low here, is going to confirm that we're ready to maybe start going back up. So watching 270 like a hawk. That straddle does not get paid unless we're above 270. Google, rejected again at the downtrend, thanks to Snapchat. Watching really closely here. I don't know what Google's going to do. They got a lot of travel ads. I'm not smart enough to guess, though. Amazon, making progress, up 8% on the week. Is this a trap, or is it the start of a W? I don't know. There's potential here, though. Tesla boomed. I was quite surprised by Tesla. We talked about 700 key low. It mooned. It also took out the weekly high I was watching here, roughly 792, and it closed near the high of the week, up 13% for a company that is worth $800 billion. That's a big move. It added as much as all that got deleted from advertisers like Meta, Google, and Snapchat. Meta, inverted hammer, thanks to Snapchat, rejected off its relative low at roughly 183. Let's look and see what happens. And then NVIDIA, is NVIDIA leading, meaning are chips leading tech and tech leading SPY? Strong bounce off of the green line at 160, broke the downtrend, we got volume coming in, and we got a 10% week. You go, NVIDIA, flex it. Looking at ETFs really fast here now too. The Dow, bouncing off the demand pocket or the green box, and almost back inside the supply zone or the yellow area. Looking at the relative low, that's 322. Our high of the week, 322. XLK, less heavy waiting for Tesla and Amazon, almost ready for a breakout. Back above 141 is a bullish break for me. Confirming by getting above 152 or the 50 weekly moving average. IWM talked about it. ARC talked about it. NYA, holding the megaphone. Equal weight S&P, filled the gap, hovering on the gap here. The gap right here is at roughly 140. Closed right at 140. Financials, bullish, up 3% on the week. Higher high in the weekly too. Nice. XLV, it's holding on the support. Right, we got that inverse head and shoulders too. Just has to get above 132 or the 50 weekly to confirm we might be going back to all-time highs. There was also something announced today, don't want to talk about it, from the WHO, which might be giving more juice to healthcare stocks. And I think that is a great place to leave it. So if you've enjoyed this video, I would really appreciate if you could smash a thumbs up and drop me a comment. I put a lot of work into these videos. I enjoy doing them. Show me a little bit of love by dropping a comment and smashing the thumbs up. If you're still watching and not subscribed yet, please do. We put out videos every single day, and we appreciate your support. Finally, there will be a video that queues up here in a moment, which talks about how I saw a potentially bullish move here, or a bear trap, which set up. And that'll queue up in a moment. Otherwise, thank you for watching, and I wish you all the best of luck this week. Thank you.